All right, last thing that needs to be covered here is something called T accounts. This is also known as balance sheets or T accounts, one or the other. And this has to do with banking. Now, everybody has their own T account, their own balance sheet, right? But we're concerned with bank balance sheets. Now, what you have is assets and liabilities. An asset is anything that counts in the bank's favor. A liability is anything that counts against it. So think of this as being money it has or money it's owed, and the liability side is money it owes elsewhere. All right, now don't worry about the black bars here. I've simplified this a little bit. Now this is called a balance sheet, and what we mean by the whole balance part is the two sides have to equal each other. So assets have to equal liabilities. All right. So let's say that a particular bank has $100,000 on deposit, all right? And that would mean, let's say that reserves, and if you see the term reserves by itself, reserves means both required reserves and excess reserves. You remember that required reserves is money the bank has to keep on hand, that they're not allowed to loan out. And excess reserves is money that it can loan out but has not yet loaned out. All right, reserves is going to be the two of those combined, both required and excess. For the time being, I've simplified it down to just reserves. All right, so let's say that the bank has $40,000 in reserves, and it's got $60,000 in loans. So what do we see? Well, we have $100,000 on this side, we have $100,000 on this side. So the $100,000 on deposit, you have $40,000 on reserve, and then $60,000 in loans, which means you have $100,000 total there. All right, so the two sides again equal each other. Now, if we add in some complications, let's say that we look at the required reserves and excess reserves, so we'll black that out. All right. Well, let's say that over here, we'll stay with the $60,000 in loans. Let's say that there is $10,000 in required reserves, and so therefore there is $30,000 in excess reserves. Okay. So again, the two sides equal each other. 100,000 here, 100,000 over here. All right. So 10,000 in required reserves, 30,000 excess reserves, $60,000 in loans. Now you might get a question that will ask you something like, well, what is the reserve requirement, or what's the percentage that has to be kept on reserve? We can figure this out by looking at this, because we have 100,000 on deposit, and 10,000 of it is required reserves. Well, what's 10,000 out of 100,000? That's 10%. So the required reserve ratio, that'd be the percentage that a bank has to keep on hand and may not loan out, in this case, is equal to 10%, because it's 10,000 out of 100,000. If this number was 20,000, it would be 20%, right? 20,000 out of 100,000. So you can figure out what the required reserve ratio is based upon this. All right. Now the $30,000 in excess reserves, that is money that has not yet been loaned out, but is available to be loaned out. Okay. Now you might get a question that will ask something like, based upon the current bank's balance sheet, by how much could the money supply increase by? Well, we need the money multiplier. Remember this concept when we looked at the monetary policy tools, right? A required reserve. All right. Actually, let me make these a little bit bigger here. So the money multiplier, you might remember, is equal to 1 divided by the required reserve ratio. Okay, in this case, it's 1 divided by 0.1, 10%, right, which is going to be 0.1. So that is equal to 10. So your money multiplier is equal to 10, right? You take 10 times the initial excess reserves amount. The beginning excess reserves amount we're dealing with is 30,000. So you do times 30,000, and we get 300,000. So the answer to our question, by how much could the money supply increase by, based upon the bank's current balance sheet, the answer would be a maximum amount of $300,000. All right. Now, you can also get different questions that are thrown at you concerning this. Let's say that it asks a question like, Cameron comes down to the bank and deposits $20,000 into the bank. By how much could the money supply increase by? What's the maximum amount? All right. Well, if Cameron comes down and deposits $20,000 into the bank, over here on the deposit side, that would increase by $20,000. Now I've got $120,000 over here, right? We need to balance it over here, all right? So we know that the required reserve ratio is 10%. What's 10% of 2,000? Or excuse me, 20,000. That's going to be 2,000. So the required reserves would increase by $2,000, all right? And the excess reserves, the rest of the $20,000 that does not have to be kept as required reserves, becomes excess reserves. So that would mean that the excess reserves over here would increase by $17,000. Oops, I messed up my math number. Oh, excuse me, that should have been 18,000. Wait, no. Yeah, 18,000. Math is hard. All right, $18,000, right? So we got $48,000 in excess reserves, right, et cetera, et cetera. Okay, now this is the setup. Let's say that at the beginning, we have $18,000 is how much the excess reserves increase by. So in this case, we would take 10 times the $18,000 that it increased by. So that would mean that based upon that one deposit by Cameron, the money supply could increase by $180,000. All right. Let's see. Sometimes it'll ask you by how much could demand deposits within the banking system increase by. That answer would be the $180,000, right, from the one deposit, right? Not only would the money supply increase by $180,000, but so would all demand deposits throughout the banking system, right? Because remember, we're making two assumptions here. The first assumption is that all the money is getting loaned out, all excess reserves is getting loaned out, and all the money that is getting loaned out is getting redeposited into the banking system. If one of those two assumptions fails to hold, then not as much money will get created as the maximum amount that hypothetically could be. All right. So this is basically bank balance sheets. Now, sometimes we'll see a question where it just says reserves instead of breaking it out into required and excess. Sometimes it'll throw some other stuff in here where it'll talk about owner's equity and buildings material and give you a dollar figure there, right? That is almost completely irrelevant to the question. They'll just throw that stuff in there to throw you off and try to get you to put that into your calculations. On the liability side, the only thing you care about is going to be what's on deposit. Okay, so that's what you want to use for calculations, what's on deposit, and then match it up with reserve stuff over here, right? Required reserves, excess reserves, and loans, right? Don't worry about the owner's equity and the building material. Don't use that as part of your calculations. All right, now let's say we put this into effect. So here we have an actual FRQ. This was, what, 2011, I believe it was. Gives you a bank balance sheet, owner's equity. Remember, we don't care about that. Demand deposits, required reserves, excess reserves, loans, government securities, building and fixtures. We don't really care about this stuff either. All right. Based upon Sewell Bank's balance sheet, calculate the required reserve ratio. Well, what we see is there's 10,000 on deposit and there's 2,000 required reserves. So 2,000 out of 10,000, our answer is then going to be 20%. All right, let me see if I can find, let me see, select text, I forgot what it was, rectangles, comment, typewriter, that'll work. So our answer here would be 20%. All right, why? Because 2,000 out of 10,000 is 20%. B, suppose that the Federal Reserve purchases $5,000 worth of bonds from Sewell Bank. What will be the change in the dollar value of each of the following immediately after purchase? Now, when the Fed purchases bonds and does it directly from Sewell Bank, the entire amount is excess reserves. The Fed is not depositing money into the bank. The Fed is paying Sewell Bank for the bonds. So actually what is happening up here is excess reserves is increasing by $5,000, and government securities is going to be going down to $2,000. Okay, so excess reserves is going up by $5,000 because they're purchasing $5,000 in bonds, so all that becomes excess reserves. And then the security amount, the bonds, is going down by $5,000. This is where the balancing is happening, because Sewell Bank is selling $5,000 of their bonds to the Fed, getting $5,000 in return. Right, so that's where the balancing is still occurring. So the excess reserves is increasing by $5,000. Okay, how much is demand deposits increasing by? The answer is 0, because that money is not going into deposits. Again, the Fed is not depositing it. It's going to be straight up 0. Okay, C, calculate the maximum amount that the money supply can change as a result of the $5,000 purchase of the bonds by the Federal Reserve. We need the money multiplier. Money multiplier is equal to 1 over the required reserve ratio. Right? In this case, we determined that the required reserve ratio is 20%, or 0.2. So that means it's 5. Okay, we take 5 times the initial excess reserves, which we determined was $5,000. So 5 times 5,000 means the money supply can increase by a total of $25,000. That's our answer. Okay. D, when the Federal Reserve purchases bonds, what will happen to the price of bonds in the bond market? The answer is one moment. Oh, sorry about that. The answer is that bond prices will rise. Okay. Now, what you need to know about this is that bond prices and interest rates go in opposite directions. Okay, bond prices and interest rates go in opposite directions. If bond prices are going, if interest rates are going down, bond prices are going up. If interest rates are going up, bond prices are going down. That's the only thing you really need to know about this. The reason is that as interest rates fall, if you are a holder of an existing bond, right, and your existing bond has a higher interest rate than what the brand new bonds are, right, that means you can charge a premium for your bond price if you're going to sell it to somebody else. Okay, and if bond prices are rising, if interest rates are rising, and you're holding an existing bond at a lower interest rate, people don't want to buy your bond. They want to buy the brand new bonds at the higher interest rate. So if you want to sell yours, you have to sell it at a discount. So bond prices will go down. Okay. Now here we know that bond or interest rates are going down because the Fed is buying bonds. Remember, buy bigger. So if they're buying bonds in the bond market, that is increasing the money supply, making the money supply bigger. And think of our money market graph. When you increase the money supply, it shifts to the right. That lowers interest rates. Okay. So we know that interest rates are going down because of the bond purchase, which is making the money supply larger. Therefore, bond prices are going up. Okay. E, suppose that instead of the purchase of bonds by the Federal Reserve, an individual deposits $5,000 of cash into her checking account, demand deposit account. What is the immediate effect of the cash deposit on the M1 measure of the money supply? The answer is there is no effect. They like to try to trick you with this question sometime. And the reason is that it says if somebody put cash into their demand deposit account, their checking account, what's the effect on M1? Well, there is no effect because cash was already in M1. All we did was transform a component of M1 from one type into another. So we transferred it from cash into a demand deposit. But the overall amount in M1 did not change. Okay? Both cash and demand deposits are in M1, so transforming it from one to the other doesn't change how much is in M1 overall. Okay?